Good morning, friends. A very warm welcome to one and all on behalf of HDFC Securities. This is your host and moderator for the day, Amit Singhania. I take care of PMS and AIF services on behalf of HDFC Securities. We all been seeing as the crazy rally in the market, the bulls in the market continue to rage. From 17,000 odd, where we ended in March 23, to close to 22,200 odd in September. It has been an outrageous bull rally yet far. Everybody has been making money. The idea with us is to create an alpha over the existing indices what we follow. And following this particular philosophy, we have invited head of investments and strategy with ICICI Prudential AMC Asset Management Company, Mr. Chintan Haria, to the screen to talk and take us through the investment strategies what ICICI Prudential has got and how they are generating alpha within this particular market out of their differentiated products across portfolio management services and alternate investment funds. Chintan, over to you, sir, please.
Yeah, thank you. Namaste. Thanks, Amit Bhai. Thank you to all the listeners for giving their time on a Saturday morning. I think, like Amit mentioned, there has been a rally which has probably taken a lot of people by surprise. But for those who've been closely connected on ground with India, either in business or in the form of traveling across India, would agree that the kind of growth that India is seeing across all sectors, across all kinds of activities is phenomenal. Just to give some data points, we are the third largest car market. We are hitting all-time highs as far as car sales is concerned. And we are on track to sell more than 40 lakh cars this year. Having said that, with a population similar to China, China sells 2.6 crore cars a year. India sells only 40 lakh cars. You can imagine the kind of growth that is possible in India. What do cars require? Roads. And if you look at the focus of this government over the last 7-8 years in terms of building roads, and arguably all of us will agree that the pace of growth of connectivity between national highways, state highways, internal roads in rural areas has been phenomenal. You just need to travel the length and breadth of India to know that the road connectivity is improving meaningfully, which essentially means more car sales, which means probably more easier trade also, right? People moving from each other. It also helps travel and tourism, wherein people can easily access the beautiful, not just religious sites, but the length and breadth of India in terms of travel and tourism also. These are the parts which are connected to us day to day. If I move out of that and look at sectors like defense, like manufacturing, there also a meaningful uptick we are seeing thanks to whatever has happened in the last 5 years, wherein one, the government was focused on ensuring India, Make in India and manufacturing starts happening in India. And it is no surprise that today we are the second largest assemblers of mobile phones. We already are the second largest steel manufacturing country in the world, second largest cement manufacturing country in the world, and the list is quite long. Earlier, we used to import everything as far as defense is concerned. Now we've started exporting defense worth 20-25,000 crores. And more importantly, the defense equipments being made in India is meaningfully increasing. Same with manufacturing. I think all of us would agree that last 10-15 years we were basically used to seeing everything that we consume, laptops which we are speaking of, mobile phones, television sets, fans, everything was probably being imported from China. Today, if you look at it, solar panels, fans, laptops now, mobile phones, the government is pushing, forcing and putting barriers by import bans in many of these imported items. And it is nudging the industry to go for domestic growth. That not only generates income, it also ensures we spend less dollars outside. All this is essentially coming from central think tank, the central government, state governments working in tandem. And you can see the benefits of GST, you can see the benefits of digitization across India. With more and more people now wanting to do business in the right manner with GST coming in, the tax collections of the government are also improving meaningfully. All this is essentially leading to Indian corporate profitability improving. And there is just one, let's say, truth in our equity markets is that if there is profits, there will be gains. When companies, corporates make profits, which increase meaningfully, the markets rewards that, and you, like Amit Bhai mentioned, are seeing the benefits of that corporate profitability growth reflecting in markets doing well. One common question which I keep getting when I'm discussing with a lot of investors like you is that we are at already all-time high. We are seeing markets meaningfully do well. There is definitely some amount of, I'd say, euphoria in mid and small caps. And is this sustainable? Is this justifiable? Why is there euphoria? Is it something that you should be worried about? Now, I started my career not so long back in 2005 October, close to 18 years back exactly. And at that time, markets were probably 1/6 of where they are. I think Nifty was close to 3,000 or 4,000. And that time also, Nifty was at an all-time high. Sensex was an all-time high. So we must not lose sight of the fact that if we look at markets, they are but a reflection of the economy. And I think everyone on this call would agree that India as a nation, since 1991, the data suggests India as a nation has been growing. Nothing has stopped the growth of India from 1991 to 2023. Neither did changing governments, neither did international European problems, Chinese problems, American fall of 2008 in terms of the global financial crisis. Neither of the problems that have happened have actually impacted the growth of India in terms of its GDP. And that is where it is reflecting in the market cap of the country, reflecting in the growth of the equity markets. The thing which happens with all investors is they look at either an all-time high or overheated markets and worry that, okay, this is not the right time to invest in equities. If you have time, then there is no right or wrong time. It's just about selecting the right product. We'll come to the products later. But it's about selecting the right product. And then, yes, if you basically entering at markets which have rallied meaningfully in the last 3 years, your return expectations should come down, but there is no choice but to be in the markets. If you have 5-year view, being in the markets is not going to hurt you. At the same time, your asset allocation is important. We at ICICI Prudential Mutual Fund, while this is a discussion on alternates, PMS and AIF, have always been significantly big proponents of asset allocation strategies. And so from an investor standpoint, a large part, if you have 100 rupees, 50 rupees should go to asset allocation strategies, that is the multi-asset strategy or the balance advantage fund category. If after you've invested there, you have money and corpus, of course, you come to the alternate side, because that's where you have a scenario wherein you can probably have more customized, tailor-made portfolios. PMS AIF, of course, in terms of risk-taking, in terms of finding the jewels, so to say, in the mid and small caps, and taking that extra call of not being too bothered about, the indices or the benchmarks, and allowing the growth of the investors' money. Also, the advantage of PMS AIF, specifically PMS, is that each portfolio in the PMS, suppose we have a portfolio which has done very well over 6 months. If you give us the money today, we may have stocks which are different from that earlier portfolio, because if the earlier portfolio stocks are expensive, we don't want your investment to come in that. So that's a big difference that comes in mutual fund versus PMS. Arguably, a large part of your portfolio will be in mutual funds in general, but if you're investing in PMS, this is the biggest advantage as we see it. And we are seeing the alternates business grow in India meaningfully as investors expand their investment horizon. Now, in alternate space, we have multiple strategies. The two in equity, which we probably, or the ones in equity, which we probably going to talk of, is Contra. And if you look at on the AIF side also, you have the Contra equivalent. So you have both options, PMS and AIF. So I'll speak of Contra, and that option is also available on AIF. And the debt markets. Now, if you look at from an investor standpoint today in India, there are but very few avenues available to invest in the debt markets where you are actually beating inflation. So if you put your money in, let's say, traditional fixed income instruments, you may meet inflation, you may not get more than inflation returns. So your buying power, purchasing power will remain same. And that's where you need to probably invest a part of your portfolio in products like the Corporate Credit Opportunities Fund, which basically is investing in credits of companies with a view to probably, you know, get a return experience which is higher than what traditional investment instruments and debt would give. I'll speak about that in detail a little later. So you have equity in alternates, you have debt in alternates, and so from an investor standpoint, we're seeing appetite on alternates increasing meaningfully. But the first part is essentially the markets. And with all the worries that you see, China slowing down, US slowing down, Europe slowing down, there's one oasis in the desert as a country called India, where economic activity is strong, domestic fund flow is strong, 16,000 crore SIP book, 4,000 crore coming from EPFO every month based on public data. And if you look at the money which is there available locally and is coming to equities, it is increasing as India's wealth grows. India's wealth of 800 lakh crores roughly, only 5% is in equities still. So it's not like as a country we've invested a lot of money in equities. Equity markets, despite we having a very low portion in equities, are doing well because our markets are not very large. If you compare the US markets, they are $50 trillion. India is a $3 trillion, $3.5 trillion market. So with the size of population, which is 18% of the global population, 140 crore out of roughly 800 crore global population, we are just 3% or 3.5% of global GDP, 3% or 3.5% of global market cap. We have no doubt that India's market cap, India's GDP as a world percentage will increase. And as India's growing prominence or growing dominance in the global era, not just geopolitically, but economically as well increases, you will find more and more opportunities in the markets. Also, the good news is that in India, you don't have just one sector. So if you are in Taiwan, we all know it's just about semiconductors. Taiwan is a large semiconductor hub. That's about it. Beyond that, Taiwan does not have much to offer. They may be having some smaller sectors, but in bulk, it is known for its semiconductors. If you were in Indonesia, it's about minerals. If you were in Malaysia, it's about palm oil. If you were in, and maybe banking. And if you were in, let's say, Korea, again, it's about technology, right? Samsung being the largest company there. If you look at India, we are lucky that with 140 crore Indians, we consume multiples of what other world countries would consume. So we are, like I mentioned, we have steel companies which are global beating companies. We have cement companies which are they are largest in their space. We have paint companies which are largest in their space. We have auto companies which are growing, and like I said, 40 lakh cars in India, 2.5 crore cars in China. There is a big gap which eventually over the next decade or two should get filled. And the list is long, right? Pharmaceuticals, 140 crore Indians consuming pharmaceutical products. We are also the pharmacy to the world. India is one of the largest exporters of medicines to the world. I think 1 in 7 tablets sold in the world globally is exported from India. So if you look at India's prowess in pharmacy, in healthcare, if you look at India's prowess also in technology, all of us know about technology, right? We are the largest outsourcers of technology, $170 billion. So technology is also a large part. Chemicals, with Europe shutting down a lot of plants, China wanting to go clean in terms of its pollution pain. Chemicals as a sector in India has grown for the last 10 years, 20 years, and probably can grow even meaningfully larger. Paper, textiles. The list is endless in terms of the opportunities available, and I have not even scratched the surface on infrastructure. India's power demand is going to increase meaningfully. We are already facing power deficits, and that means the entire power sector, the entire infrastructure sector grows. And if manufacturing as a percentage of GDP is going to grow, we'll need more power, we'll need more infrastructure. And I think with the government's focus on power, infrastructure, manufacturing, we are on the right direction as far as employment generation is also concerned. So India has a lot to offer. We have such large engineering companies, we have large refining companies. There are a lot of potential investment opportunities available. Now, in the entire electronic sector, manufacturing sector, there is a push, and we're seeing that happening across the board. So India is about 4,000, 5,000 listed companies. Around 2,000 of them are investable as far as PMS AIF are concerned. And so it's about selecting the good 30, 40 stocks. That makes a very big important point. And here I'd like to probably caution all of you as well, that in bull markets, it's always easy to think that I myself can manage my money. I can invest based on what I hear, what I see, and make a lot of money. Yes, in bull market, it works. And many people do feel that false sense of comfort that, yeah, I also know how to manage my money. I can do that. I don't need any professional fund manager to help me. It's when the tide turns and when the markets fall, most people realize that what they were owning and what's probably given them money was probably not the right thing to own. So that's where professional expertise in managing money is extremely important. And hence, I'd urge all of you that in bull markets, maximum mistakes happen. Try to curtail those mistakes by having a good balance of professionally managed money as part of your overall portfolio. If you're investing directly, no harm in it. Everyone does that in some form or the other if they are allowed to, and that gives a good happiness as well that you manage money on your. All of us get that happiness, but professionally managed money is obviously that much more important. And I'll explain with a few slides. What do I mean when we say professionally managed money and what goes behind managing the money, and what are the key attributes that you should keep in mind when you are looking to buy stocks or when you're looking to basically build a portfolio. So I have a few slides to share with you. I'll keep it short and crisp and simple. I don't want to go into too much of jargons, but it is important to get the more important points as far as the markets are concerned. So obviously, markets is all about volatility and risk. And when Amit Bhai mentioned that we are at an all-time high and there's euphoria, clearly we've seen a lot less volatility in the markets, except for a couple of days back, we had this big fall in small caps. But markets volatility in India, just to highlight to all of you who understand derivatives, in India, the last 10 days realized historical volatility, that is the change in market, that is the large cap Nifty, was only 4.5, which essentially means that the market volatility is the lowest that has been on record. So markets have been quite complacent, which essentially increases the risk. So we can't control market volatility because there are so many factors. As you can see in front of you, markets in the short run have many ups and downs, but in the long run, if you invest today and open your eyes after 20 years, and if the money is managed well, the kind of compounding and the gains that you can see is meaningful. What can happen in next 6 months, 12 months, we do not know. So number one, when you're investing in equities, minimum have a 5-year view. If you think you need the money in 3 years time, 2 years time, do not invest in equities. Second, if you're investing in equities, if you have 100 rupees, have a diversification in your portfolio in a manner that the 50% that you're putting in multi-asset strategies and balance advantage fund strategies, rest 50%, you can pretty much decide based on your risk appetite where you want to invest. That will help you to basically tide over these ups and downs which are happening in the market. If you look at volatility, we all know volatility can have many reasons, global reasons, US global financial crisis, China problems recently. There are many, and none of us can control global reasons. There can be political reasons as well. But what we can control is risk, and that's where professionally managed money helps in terms of risk management. What we believe in ICICI is that at all points of time, no matter where, if you see there are many numbers, but the thing which is basically being depicted in these numbers is that at all points of time, there are between 70 and 250 companies, which if you select at any point of time in the market, up, down, bad years, good years, they're able to generate more than 15% returns for you. So now the trick is that as a fund manager, am I able to pick this 200? So out of 1,000 stocks in India, 500, 600 are investable. You will always find 100, 200 stocks, which over the next 5 years are capable of generating higher returns. And for that, what is important is the profits should be growing, which is the EPS. And when profits grow, historically it has been seen when profits grow, this chart is showing that those companies which grow their earnings at more than 15%, there have been 105 companies in the data that we've seen 2007 to 2022. they see their profits growing and their multiples or the market valuations also expand. So it's about catching those companies which are growing and expanding those multiples. And that's where, like I said, a full-fledged professional managed research team is of extreme importance. I've been in this industry for 18 years, and I can tell you, I'm in my earlier avatar between 2005 and 2016. I was in the dealing desk, I was a research analyst, I was a fund manager, I was managing about 5,000 crores. The point is that I could also not know everything about all stocks in every sector. And hence, you need a team which is able to basically deep dive. And if you see in front of you, there are about about 30 to 40 analysts that we have, apart from the fund managers, the CIO, the head of PMS, Anand Shah, who are basically these analysts look at these sectors. So there'll be an analyst who would look at bank and finance. There'll be an analyst who would look at construction. There'll be an analyst who would look at pharma. So one person is dedicated to look at these sectors, right? Each person is looking at his particular or her particular sector. And then those 20, 30 companies that that person is looking at, that person is an expert in those sectors or that particular sector and stocks. They know what's happening, and then the job is to pick those 5, 6 names from that particular sector which the analyst likes. And then if you look at these 20, 25 sectors and about 5, 6 names each in each sector, there is a list of 100, 125 companies which are there, which are looking good. Then as a fund manager, based on my objective of my fund, based on the requirements of my portfolio construction, I pick up 25 to 30 names such a manner that I'm able to basically create the alpha which Amit Bhai was mentioning. The objective is that if the market is giving some return, we should be able to give more returns. If market falls, we should be able to fall less if it's possible. And that's the job of the fund manager. And that's where this entire team, which you can see in front of you, so the investment team at PMS AIF, led by Anand Shah, more than 25 years of experience. Choka Gitika, again, more than 15, 20 years of experience. The dealing team, the research team, the investment support team are all basically clued towards ensuring that they pick those 25, 30 names based on BMV. What is BMV? It's essentially good businesses with longevity, managements which have seen cycles and test of time. So basically a business which has been there for 10, 15, 20 years, has some strength in the business, has a management which can grow the business, and most important is valuation. Now, when you have a good business, great management, but if valuations are expensive, you may not end up making money out of that. And we've seen that happen. In 2020, many great businesses were available at very expensive valuations. And in this rally, which we've seen over the last 2 years, they've not participated. So many of you would have experienced that if it's a very expensive company, 80p, 90p, 100p, the company is great, but it's not necessary that it will make money for you all the time. So you need to be having a portfolio where the business is great, management is good, and the valuation is reasonable, right? And that's where the expertise of the fund management comes in. We have about 2,500 stocks which are in the screener. We have 470 stocks under active coverage. Like I said, within active coverage, about 125 stocks. So each analyst will have 5, 6 stocks which they like. And then based on the strategies, the filters are put. I'm going through this quickly because essentially, if you look at in India, these are the 5, 6 spaces which are growing meaningfully. Like I said, banking, we all know, India is lucky that it has some of the best banks, and more importantly, and I strongly feel that, the best banking regulator. Like in asset management company, our mutual funds has probably the best regulator. The banking sector has the best regulator. So I think India is lucky that regulatory framework is in favor of the country, is in favor of growth. And we are seeing that change towards ensuring that the regulatory framework for manufacturing also is improving. The focus on logistics, manufacturing, industrial products is improving. So we have a good mix of these sectors across all our portfolios. And if you look at the contra portfolio, which is there, you have banking and financial services. I mean, we all know, right? Can we live without car insurance? Can we live without our health insurance? Can we live without our own personal insurance? Even if it's a term insurance, the answer is no. And so if you look at from that perspective, the financial services market in India is going to boom meaningfully. You look at your own experience. Out of 100 rupees, say 20 years back, how much of your money was in financial assets? How much of your money was in physical assets? And today, incrementally, how much of your money is going towards financial assets. And that's the nature of growth of any country. As the country grows and the savings grow, financial assets grow. And it's also easy. I mean, all of us who've basically seen and probably dealt with real estate would know it's not easy to deal with physical assets, but financial assets, it's that much easier. And through my interactions across India with the length and breadth of family offices, HNIs, I'm seeing this growing trend of investors wanting to invest in financial assets because in one instrument or a couple of instruments, they're getting to participate in multiple growth opportunities available in India. So if you're looking at this particular fund, which is Contra, ICICI Prudential Contra PMS, the exposure you get to financial services allows you to get exposure to not just banks, but the bank subsidiaries, which are in asset management, insurance, be general insurance or life insurance, broking. And so it is a simpler way to participate in a wider spectrum of businesses, wider spectrum of growth opportunities available in India. Similarly, if you look at manufacturing and manufacturing allied, you'll have auto ancillaries, you'll have defense companies, and so on and so forth. In terms of the growth, you'll have logistic companies, and the kind of, and I'm not even going by the past returns. We all know that last 3 years, because of the base of COVID and the improvement that the world has seen after that, specifically India, the returns in India markets have been good, led by the profitability growth, and that's where the profitability growth is, even in the portfolios, is looking good relative to market. Now, the job of the fund manager is to pick the stocks whose profitability is going to grow better than the market, and hence the portfolio will give a better return than the market. So if you look at, and I'm going through all these slides faster because they probably I've already discussed them in some manner, but the point being that there is a very strong opportunity set in India over the next 10 to 15 years that is emerging. I go back in history, and if you look at Japan between 1970 to 1990, it grew meaningfully on the back of exporting to US and the world, and the Japanese revolution made Japan a very rich country. Then of course they matured as a economy, they probably aged as an economy, and because of age catching up, and we all know that Japan is actually degrowing in population, Japan started to see a fall after that huge uptick that they saw in 1990. Then came China between 1995 and 2015, and arguably India since 2013-14 till probably 2023 will have its own 2 decades of growth, which is much faster than the rest of the world. So if you look at India, and I'll end in the next maybe 7-8 minutes. If you look at India, we have all the ingredients today. Geopolitically, we are, yes, there's a problem with our northern neighbors on both sides. But apart from that, the successful G20 summit also showed us that we have a lot of friends in the West. We have a lot of friends in the East as well. The only thing we should remember is that they are our friends because our economy is strong and our economy is growing. So outside of India, of course, everyone is looking at India as a market for selling their products, for making money, which is fair. And so India will be an important partner for everyone because of the 140 crore Indians and the 50 crore middle class population, which is strong. So this is the portfolio of the Contra strategy. If you look at the investments, most of the names would be known to all of you all. It's not like these names are not known. And so some names, of course, you may probably not have heard of. But if you look at the portfolio construct, the sectoral construct, it is well diversified. If you look at the large cap, mid cap also, 55% large cap, small cap 26, 21. And as long as you've selected the right small cap, right mid cap with potential to grow and earnings, more importantly, visibility being strong and valuation strong, I don't think you need to worry about it. And that's where in the last 2, 3, 4, 5 years, I think Contra just completed 5 years as a strategy. We've been able to deliver this performance of Contra. I'd like to again highlight to all of you, the ICICI Prudential Contra PMS has not come on the back of creating a portfolio and then as more money comes, having the same portfolio continuously. It's basically built on changing the portfolio as we move along. And so for your investment purpose, if you do like a fund which is betting on India's manufacturing growth, which is betting on the growth of India across manufacturing, finance, and picking stocks which good businesses, long-term management vision, and more importantly, valuations being reasonable, then contra fund will fit in well in your PMS portfolio. It is a diversified fund across sectors. It has large, mid, and small caps. So you're basically getting the entire market in a very easy manner. Now, from a investor standpoint, I mean, that's the same with the equity opportunities AIF as well. A similar portfolio that's on the AIF platform. The thought process remains same as contra, that we need to find opportunities across. Now, the important aspect, if you look at it, is that valuation wise, the portfolios are not very expensive because, like I said, we have a scenario wherein, and I'll stop here, we have a scenario wherein there are a lot of opportunities available in the market, but investors are worried. Look at your overall portfolio. Don't be worried as long as you have a more than 5-year vision in terms of holding power. If you need money in the next 2-3 years, do not invest in equities. But if you have 5 years holding power, you can look at investing in equities without worrying too much. Every now and then there will be falls. Even in the last 3 years, if I remember, there was a big fall which happened between January and June 2022. There was a big fall which happened in March 23. And these falls will keep coming. And when I say big falls relative to past, these are smaller falls, but they're still basically corrections in market. As was shown in one of the charts earlier, corrections are part of equity markets because equity markets have a lot of forces playing around, with the fact that everything that is volatile impacts the equity markets first. But if you have to beat inflation, and we are going to see in the next 5-10 years, inflation go up across the world. The world is in a problem as far as debt is concerned, and there is no choice but for the world to grow its nominal GDP to grow out of debt. Now, this may sound technical, but it's very simple, that if there is 100 rupees debt which is there, and I don't have the ability to repay it, I would want to grow my economy in nominal terms by pushing inflation higher. So debt remains 100 rupees, but my economy grows because of inflation. And so debt as a percentage of economy comes down. We saw that happen in US in 1945. And I think that will repeat in US possibly now, which essentially means that you all have to brace for higher inflation in the next 5-10 years. And in inflation, what works is, of course, gold works. So gold as an asset class works, and equities as an asset class works. It will be a volatile world, but you have to be in equities. There is no choice. And as long as the fund manager is picking the right stocks, which we are doing in the contra PMS, the equity opportunities PMS, you don't have to worry. Now, I just possibly take about 2-3 minutes of your time on the corporate credit opportunities fund, which we have. Now, on the debt side, purely, the 12 to 14% return segment by lending to promoters for a lot of activities where the banks cannot lend to them is a very sweet spot. It is not real estate financing. It is not that high yield financing of 18, 19, 20%, but the 12 to 14%. And we've already had an experience in the last 1.5 years of the corporate credit opportunities fund 1, wherein we had raised 1,500 crores. We've deployed 900 crores at about 13.75% in 8 different papers and with security, which is strong. So we already have that experience, and we've launched the corporate credit opportunities 2 to allow investors to participate in that 30,000-40,000 crore market, which is there annually, wherein 12 to 14% is the return expectation or the targeted return expectation. Of course, there will be expense ratio, there will be tax on that. But in a scenario where debt today, even if you invest in a debt mutual fund, the taxation is marginal taxation. Insurance above a particular amount is marginal taxation. PF above a particular amount is marginal taxation. MLDs have become marginal taxation. As an HNI investor, very few opportunities are available try to basically have, on the debt side, there's practically nothing available. So if you look at it, the corporate credit opportunities fund with the kind of risk management that ICICI Prudential brings in is a good fit for all of you all to participate in debt markets where that 12 to 14% range is being targeted for papers which are basically in the nature of lending to promoters, promoter entities. Suppose a promoter wants to buy out another company. Generally, banks may or may not be able to lend for such a transaction. And mutual funds earlier probably could do that through loan against shares, but now with the regulatory changes happening where you need 4x cover on the loans against shares, mutual fund probably is has got a disadvantage when it comes to promoters. On the AIF side, at a cover of 2 times, the promoters can be lent, which essentially means that in very simple terms, promoters' comfort to take money from AIFs like the Corporate Credit Opportunities Fund is slightly higher because they have to give lesser security. Lesser security does not mean that money is not going to come back. In Corporate Credit Opportunities Fund, the 2 or 3 things that you need to see is where is the money going? Is the money going to come back? And what is the yield, right? And that's where the risk management practices of ICICI Prudential, where for the last 25 years that we've been in existence, we've not seen a single day of delay or default. We do hope that continues. I mean, last 5-6 years have been extremely difficult on debt, but that still has meant that we've been able to wade through that, and 2.5 lakh crore debt portfolio has not seen a single day of delay or default. We have strong risk management practices, strong liquidity. The way we manage our debt funds, we've been able to basically look at safety and liquidity first, and then basically returns. And that's what we are doing even in Corporate Credit Opportunities Fund. I do urge all of you all to at least probably allow your relationship manager to explain to you what is the opportunity available in the Corporate Credit Opportunities Fund for you to generate that slightly more importantly, inflation beating returns in your debt portfolio through the credit investments which are there, because that space is growing and most HNIs are looking at that space now with the taxation change happening. With that, I'll stop. Over to you, Amit, if there are any questions which I need to answer. Otherwise, we can end the call. Thank you so much.
Thank you so much for this wonderful take through to the entire market synopsis, and also through your logics, your stock building logics as to how you buy those stocks, the entire universe of those stocks, how you put them down. Guys, I think time for questions. If at all you have any, please get them on the screens. Meanwhile, Chintan, a couple of questions from my end to start with. One pretty common question which you kind of addressed within the presentation also, which I'd like to put up once again. ये एक यूजुअल क्वेश्चन आता है क्लाइंट के साथ में कि 20,000 का निफ्टी अमित जी अभी ये मार्केट में इन्वेस्ट कैसे करना चाहिए, डू वी वेट, डू वी गेट इन्वेस्टेड राइट अवे, you know, thanks to the overflow of information what we all have today, and also the WhatsApp university, everybody knows the positive data on the Indian economy, and everybody is looking up to that particular thing. But navigating within equities, within the asset classes, over the next 5-7 years, how do you put it up? 20,000 ka Nifty, it still makes sense to invest? How?
So let's get the comparisons done. And thank you for asking that question, because most people feel, oh, there's a very large, sharp fall which is possible and markets are overheated. Let's just do the math, compare it with the previous biggest fall that we've seen in our markets around 2008. So those who have seen 2008 know that in India, we fell about 60% or 65% from a high of 6,200 on January 2008 to October 2008, about 2,300 on the Nifty. During that time, if I start from comparing with January 2008 and September 2023, just look at January 2008 and September 2023. Our market cap to GDP in January 2008, which is a very important indicator, essentially the market value of all the stocks to the GDP. 75 lakh crore market cap, 45 lakh crore GDP was in 2008. That was 160%. So our economy size also was only 45 lakh crore. Today our economy size is 305 lakh crore. We were a 45 lakh crore economy just 15 years back. Today we are a good 305 lakh crore economy and growing meaningfully faster than the world. So we've already gone up 8 times roughly in the last 15 years in rupee terms. 160% market cap to GDP then. Today, what is the market cap to GDP? 100%. So 160% versus 100%. You can see the extent of overvaluation that was there in 2008. So number one, if anyone thinks that, oh, there is a very, very, very large sharp fall possible. How can we say a very large sharp fall possible if on a valuation standpoint versus 160 we were at 100? Can we go from 100 to 80? Possible. That would be a very sharp fall, but that sharp fall means 25% compared to 60% fall that we saw in 2008. Is there a trigger right now for that 25% fall? The answer is no. Our earnings growth is strong, but we are not at an advanced economic cycle. In 2008, we had peak growth, peak earnings, peak valuation. Today, our growth has just started in the last 3 years, and we have a runway of 4-5 years. Our multiples, earnings multiple, at least Nifty, if you look at it, is 22 times trailing, 18 times forward, right? So it's not at the 27, 28 times earnings that it was way back in 2008. So we are reasonable in earnings. Our economic cycle is in the mid cycle. It's not in an advanced cycle. Our earnings cycle is also not at an advanced cycle. And also, if you look at the corporates, we are at the lowest corporate debt to GDP. Our banking system is lowest in its NPA in the last 20 years history. It is a very strong banking system, a very strong corporate system. You look at the leading companies in Nifty today, almost all of them are debt free. Even metal companies have repaid debt to such an extent that they are on the verge of being debt free. I won't say that they are debt free metal companies, but the point being that as a country, we are in a far better shape than what we were in 2008 in terms of corporate structure, and yet the valuations are nowhere close to 2008. Plus, the most important aspect, India's culture of equity, which was strong in 1990s, early 1990s, went through a very big dive leading to 2004-5. 2008, we saw some peak. Then again, it's gone up and down. Today, if you look at an SIP book of 15,000, 16,000 crores, EPFO investing 4,000-5,000 crores a year, it's a very strong domestic flow cycle also. As long as there is no major global accident. What do I mean by major global accident? Like you mentioned that every one of us knows positives about India. There's so much information, probably a lot of information overload also. The risk is not because of Indian markets. The risk is that if US nosedives, and what do I mean by that? If US increases interest rates from the current 5% to 8%, the entire world economic activity will come down meaningfully. The valuations will come down meaningfully because valuations are a function of interest rate in the system. Lower interest rates, higher valuations, higher interest rates, lower valuations, and hence US is vulnerable, Europe is vulnerable, China is already going through its bad time. So India will be the least affected, but we will be affected, and hence versus the 60% fall that we saw in 2008, be prepared for a maximum fall which may come as I sense from 100% of GDP to 80% of GDP. None of us can predict the exact bottom, but ideally, given the circumstances in which we are right now, we should not fall below that. And if you're investing in equities and you do not have the ability, probably you should never be in equities, because equities are an asset class which will go up 50% one year, come down 25% the other year, and then through that chart, if you see the overall long-term chart, it will have its ups and downs. So you are right. All of us know the positives, which is the good news. And also the good news is those positives are real. They are not made up. We all know, I mean, if you look at the anecdotal evidence I already mentioned, largest car sales, we are seeing consumers spending. We are in the mid of a festival season. There is an element of course, pain which may be there because of inflation in the lower strata. But corporate profitability is a function of the top 50 crore Indians who are spending, and not the function of the 80 crore Indians who are struggling. And hence, while we all empathize with all population of India and we want everyone to prosper, the corporate profitability is a function of the 20 crore Indians who are going to spend, 30 crore Indians who are going to spend. The balance spending is an upcycle or an uptick or a bonus which comes to the corporate India. And so I am not worried about India for the next 10 years. But yes, as an investor, I again repeat, and I strongly repeat, you need to be in professionally managed funds. That's where the contra PMS, the equity opportunities AIF are something which you should look at. Individual investing or direct investing can hurt you at times when markets come down, because you will not know what you're left with. as such, because you'll not know the companies in detail, and have a 5-year horizon. If you don't have a 5-year horizon, do not invest in equities. Thank you. Over to you. Is there any other question, Amit bhai? I can't hear you.
Thank you so much, Chintan, for this detailed analysis on.
I can hear you. I can hear you.
No, Chintan, I do not see any. One more from my end. Since we are into the election year, a big political event being on hand, and usually we see a lot of volatility and the kind of questions what we get from our clients as to navigation on fundamental is one aspect of equities, but navigation into investing into an election year is another thing. Any house views on the same?
So election is your guess versus mine when it comes to democracy. But if you look at in general the work that has been done in India over the last 5 years, I do not think there is any reason for us to believe that there is a big shift that has happened away from the current government towards any other alternative that is there. So none of us can predict elections. At the same time, if you just take a general opinion of most people across most states, at least as far as central government is concerned, there is a belief that there will be continuity post 2024 also. The extent of mandate can probably be questioned whether it will be as strong as 2019. But to believe that there's going to be a change in government in 2024, as of now, based on what we are seeing, looks difficult. There are a few state elections like Madhya Pradesh, Rajasthan expected in the next few months. But state elections have their local issues, and the local establishment in state is far stronger across many political parties. But when it comes to the center, last 10 years and the growth of India has proven that there is some element of tailwind with the current establishment, and that probably does not look like getting changed in 2024. Thank you. Amit bhai?
Chintan, we have some questions from our customers. So
Last question we have got from Mr. Gandhi, if at all he invests today, what should be the returns expected in the next 5 years until 2028?
So if you look at the starting point where we are, arguably expansion of multiple, meaning from forward 18 and trailing 22, there is no kicker of expansion of earnings multiple which can lead to returns. So the returns will be a function of earnings growth and GDP growth. So returns from here on will not be led by expansion of multiples or valuations, but by earnings growth, and earnings growth are a function of GDP growth. So the question comes, what is the GDP growth which we can expect in India over the next 5 years? Then of course the fund manager picking the right stocks, right sectors, which have faster growth than GDP, which leads to, and they are cheaper than market valuations, which become then more expensive. So the fund management alpha will probably take care of itself in terms of how well we manage. There is a chance that we may not manage well, we may manage well. That's only time will tell. Our objective, of course, is to manage well. In last 5 years have shown we've been able to manage well. But in terms of return expectation till 2028, if our GDP on a real basis grows 6%, and there is an inflation element of 6%, that's about 12% growth in GDP we can expect every year for the next 5 years. And on that 12%, there is an alpha which the fund manager seeks to generate. Whether that alpha is 1%, 2%, 3%, 4%, 5%, that's difficult to predict because it all depends on the style working. It all depends on how good the fund manager does. But And to an extent, there's a possibility of negative alpha if that style of fund manager goes through. And hence, we always say diversify your bets. Don't put all your eggs in one basket, because one fund manager will have one style, the other fund manager will have another style. One style is not better than the other style. Some market cycles, one style works, some market cycle, other style works. So if you can get the market cycles and the fund manager style matching, then you basically keep compounding at a much faster rate than your peers. That's how it works. So 12% if GDP is growing, depending on whatever alpha the fund manager generates, I think it's safe to assume that if you close your eyes today and open your eyes after 5 years as such, from an investment standpoint, 12% is a good number to anchor yourself, and then over, above, or below will depend on probably what the fund manager does in terms of alpha generation or destruction. But if you ask me, do not expect the 30% which have happened in the last 3 years, because that would be foolhardy. This 12% which I'm talking, possibly 12 plus 12 plus 12 plus 12, it will not happen in a straight line, because that's not how equities work. It can so happen that in the next 1 year you get 20% return, and then 2 years after that you get 0% return. So that's also possible. In equities, you get a lot of return upfronted, then there is a consolidation, slight mild correction or a correction phase, then again that uptick happens. So starting point, like I said, you do not have an earnings growth, you do not have a valuation multiple expansion. We are not going to go from 22 times trailing to 28 times trailing that easily. 5-year basis I'm talking. So can it be possible that in 6 months time we go from 22 P to 27 P? That's possible. But on a 5-year basis, it does not look like, because 27 is not sustainable. 20 P is probably sustainable with interest rates being what they are. And earnings growth is going to be in the range of 12% GDP ke aspas. So keep in your mind as an anchor that I should expect equity 12%, I should expect debt 8%, corporate credit opportunities fund, which is in the 12 to 14% bracket. The taxation is different, of course, over there. You'll be taxed at marginal rate. So net result after equity taxation will be slightly lower. But it will not be in a straight line, and hence if you are investing today, keep your asset allocation in mind. If you are 0 in equity today, suddenly don't become 100 in equity, because markets are not that cheap that you should become 100. At the same time, you cannot be 0 in equity today, and which many people are. So choose an in-between, wherein say 30% of your corpus you invest in equities, 40% of your corpus you invest in equities, and keep it for 5 years. I think a good number to go by as far as your assumption of the rate of return that equities can give you is 12%. I know many of you will feel 12% is not big, but actually 12% is quite large in the context of the fact that risk-free rate in the world and in India is close to the 6-7% range. To expect equity markets to deliver more than 4 to 5% compared to debt markets on a 5-year basis, that too on a starting base that where we are, is actually trying to fool yourself, and I'm not in the business of fooling anyone. So the point is, keep your expectations low. At the same time, there are opportunities which are there in India, and it has been proven for the last 30 years, and maybe when we'll be speaking after 20 years also, that it's about patience. It's about patience, long-term investing, and the expectation of return on equities. So like we say, debt is about 7 to 8%, hybrid about 10%, which is debt and equity put together. Equity is at 12%. These are good numbers, ballparks to go by. Can anyone be accountable to that ye hona hi chahiye? Obviously not, because it is not in our control. But if GDP grows 12%, yes. If India's GDP tomorrow suddenly grows by 2%, and then inflation comes down to 4% because global depression is there, then in that scenario, you're talking of 6% growth in nominal GDP. So your return expectation from equity should also come down meaningfully. So we are all essentially a byproduct of the GDP growth of the country. GDP growth currently looks like 12%, but if there is a global depression, it can come down. It can compress our valuations from the current 22 to 17, 16, 15 also. And that is the time where you can see a correction in market. So keep money in hand to invest if there is a fall. At the same time, keep some base money in equities in a sensible manner, because none of us can time it well. So it was a long answer, but it was important to give the backdrop that 12% is a good number where we are starting from a 5-year perspective. Thank you.
Thank you, Chintan bhai. I think answered wonderfully well, giving some insights into fundamental concepts as to how returns are to be calculated across both debt as well as equity asset classes. Last call for questions today. Chintan bhai, am I audible?
Yeah, I can hear you. I can hear you, Amit bhai. Your screen is frozen, but we can hear you.
Yeah.
I think we've overshot time as well of investors. So if there are no more questions, we can end the call. I'm okay if there are questions to answer, but investors will need to
Yeah, my
talk.
apologies. Have some network errors. I think there are no further questions. Chintan bhai, thank you so much for being with us today and sharing all this gyan. It's been a constant endeavor to bring the best of the products available across classes to all our clients, to all our valuable clients out there. Thank you so much for spending time on this valuable Saturday with HDFC. Looking forward to reconnecting with you over a lot many ideas. Thank you so much, guys. Have a nice week.
Thank you, everyone, and have a great festive season ahead. Thank you.